Hopefully the stream can hear me or the recordings can hear me. Okay, so let's do a market recap. March 17th, Tuesday. Alright, let's start off by looking at the NASDAQ. We've been on a pretty big downtrend ever since the double top formed on the top of this range. We've been down most 7%, actually almost 7.1%. It's sort of been a downtrend ever since. Every rip gets sold, but it's also finding a support at 593-ish. And as it is respecting the trend line, I think in the next few weeks we expect it to keep going down, and it's gonna eventually make a decision at this point, 593, to it's either gonna be something like this, a dead cat bounce and then really flush it, or it could also, as it gets closer to this, have a rip and then go lower as well, depending on what catalyst we have in the next few weeks. And speaking of catalysts, I was looking at the biggest geological and financial events for this week and next week. So of course the biggest thing right now is the Middle East conflict and the oil shock. And it is not getting better. There's a lot of false information out there. I really think the market should have died either on this day, like 2 weeks ago, early March, or the last week's Monday, or maybe even last Friday. I think everyone sort of take Trump's words at his face value at this point. So when Trump said, "Oh, the war's ending soon," I think that really saved the market from going even lower. And of course, now everyone doesn't know what to do, and you can see this mega chop right here for 40 days. That's almost a month of mega chop. US side says, "Oh, war's going good, we're destroying their navies, we took out their air defense systems." Iran says they still have a bunch of missiles and drones in their arsenal, they're ready to deploy more. And the Strait of Hormuz is completely closed. Only people that Iran agrees can go. I think a few oil tankers went through to China. I think anything that Iran's ally, so basically like China, but Russia doesn't really need oil, so nothing's really going through Russia right now. And I think last week or 2 weeks ago, a Thai oil tanker got got hit by a missile, and that really tanked the market for a little bit. I think it was here, this big gap down here. And institutional hedge, which is put options, where asset managers selling, is at its highest level. And RSI, is this even RSI? What is this? It's RSI, yeah. I mean, RSI is still not too oversold yet. It's at like constantly below 50. And of course, if you look at the oil price, it's quite literally the inverse of the equities market. But I think oil has more of a dominance over the market right now. As you can see, it's sort of lagging, right? Like a big oil day on Thursday leads to a bigger sell-off on Friday. And this is also, I think, either when Trump said the war's almost over, or they just pile in a bunch of shorts on the futures market that day. Because if he doesn't do anything, this stuff is going to go way above 120. And yeah, it just goes straight below past, maybe even all-time high to 150. But, Trump is doing everything he can to save the U.S. economy. As you know, inflation is sort of calming down. Before March, February was fine, January was fine, and but the S&P and also NASDAQ, which is having a hard time pushing through all-time highs, and it just really looks like a distribution phase right now, right here. So that's why a lot of quote unquote smart money or good traders are looking at this asset distribution phase, which is eventually going to lead to even more sell off later. And it's probably the end of a business cycle as oil price go up, inflation go up, and nothing can really save the economy, especially the U.S. economy, as jobs are getting worse. Which the purpose of the Federal Reserve is to change the rates to either combat inflation or combat a weak labor market. It can't do both, right? It's a double-edged sword. So once you have two problems, both happening at the same time, that is when a recession happens. So as you can see, oil is sort of gaining its strength again, trying to push over 100. It failed on Monday, 2 days ago. But it kind of finds support already at 95, 94-ish. And also moving average is catching up. It's quite extended, so it makes sense that it's just chopping around at 95. Yeah, not too many people are selling, and we like the market's trying to price in the market's trying to price in how real this oil shock really is. Because usually when there's an oil issue, like here, when it just spiked in last year, June, it immediately gets sold off, right? Even here, January 2025, even this one, September 2025, it wasn't super extended loss. It was really when, I think this is 2021, yeah, so both inflation was bad, they tried to start cutting, and then the Russian war started somewhere in March, April-ish. That's where the spike is coming from. Yeah, so given the current oil price, worst case, it'll be a repeat of this, right? A big spike up, gets stuff down, and then chops around. Eventually try to break the new high, but fails to do so because I think they resolved with some sanctions, and also I think people just forget about wars, to be honest. This Ukraine-Russia war has been going on for 4 years now. It doesn't really affect the markets anymore as much. And yeah, we'll see how this one plays out. But this is more of a more fundamental issue, as Strait of Hormuz controls 20 to 30%, or maybe even more, oil supply in the world. It also has heavy influence on the Gulf countries, which have been investing in U.S. economy nonstop. Basically, the business model is Gulf countries like the UAE, Iraq, I think Oman, all those rich, Qatar, all those rich Gulf countries sell oil, get paid in dollars, and invest them in the U.S. market. And it's really at a big decision point right now in the market. So Nasdaq is still following this downtrend. Now let's look at some of the strongest sectors. Which energy, of course, is going up. Same as oil price, gas price, all those things are going up. So as these sectors do well with inflations, right? In 2022, it had a massive 2021, 2022 had a massive run as well. And people start pricing in rate cuts in 2023, 2024. So we started, kind of just accumulating here. And this is what market needs to decide. Is this accumulating to go to a new high or accumulating to go to a lower low? I mean, the broader market, the Nasdaq and etc. And within this, oil services had a pretty good run before the war started happening. And once the war happened, which is I think late February, early March, started to have a little correction. I think mainly just people taking profits. I think this is a really good time to buy OIH actually. If Strait of Hormuz is not going to get sorted out very cleanly. U.S. asked for help, which is already sort of a sign of weakness. And I think China rejected, U.S. rejected, Korea rejected, all the European countries rejected. And Trump is pretty mad about that. So let's see how he handles it. And another sector that's been doing really bad is the financial sector, which is not good, right, for the entire market. Private credit. and private loans are doing very bad right now. As you can see, I think there's a chart somewhere that Wells Fargo has the most exposure to private debt or private credit. If you get Wells Fargo, yeah, it has the most beat down like compared to. It's already down 24%, whereas XLF as an industry only had a 13% drop. Yeah, so Wells Fargo is definitely the one that's exposed to private credit, and we know that this is caused by the private credit crisis or issues, what you would call it, which could lead to sort of a recession 2008 situation if it's not handled properly. But I don't think it will be as sudden and as bad as 2008, and you can go back 2008 and see what happened there. Weekly, yeah, like this was bad, man. Like it was down 80% as a sector, but if you just put in the S&P as a comparison, I'm sure it didn't drop as much. Right, like at this point, it was only minus 52%. So financial sector definitely take a heavier beating in these situations. Okay, now let's look at another very strong sector or a big sector within the indexes and the broader market, which is this technology, technology slash software. And you can use NASDAQ as a broader comparison. From the highs, it's doing a little bit worse. It's a little bit oversold as in here. I think mainly the earnings, the multiples was getting a little too inflated. Like Palantir sold off really hard, which is one of the bigger names in software. Microsoft got sold off pretty hard. So a sector by itself, it's down a little bit more than NASDAQ, 2% more, 2.5% more. But if you look at semiconductor, which is a part of the bottom market, also a part of the technology sector, it is not down as much, 12%. And for software is actually it's about the same. 12, 10, 11% around there. Let's SMH. Let's see how much is down really. I mean, it definitely not doing as well. Okay, maybe see the chip sector is doing a little bit better off of the highs. It even made a new high after. Actually, let's go. Actually made a later high in mid-February, and it just started to correct. So there's that, and of course, if energy is doing well, I'm assuming utilities is doing well as well. These are all sort of goes along with oil prices, energy prices. So these are all good hedges compared to the tech sector. Okay, now let's look at Bitcoin, because this sort of follows with software. You can see it kind of matches up, except I think Bitcoin price things a little bit faster and earlier, so we could expect maybe a bigger drop in technology in general. So there are a lot of hopeful bulls in the crypto industry. They think it's already down and it's already, it already went below the previous cycle all-time high. But if you really go back and look at the drawdowns in the bear market, let me find it. Here, USD, USD, you can see that almost every time it corrects, actually a lot more than you think. So for the 2013 cycle, it dropped as much as 86%. Probably won't be as bad this time. Again, 84%. Last bear market dropped 70%. So it's pretty safe to say it's gonna drop, about 70%. So if given that context in mind, 70% would put us right at 35,000, 37,000 ish. So I think Bitcoin still has more to go. But it is performing relatively well compared to some other assets in the past few weeks. But as you can see, I pointed out, this is just a typical pattern in bear markets. Sudden drop, a little, upward channel accumulation, bait in some bulls, and then once a wick is put in, it drops again, a pretty vicious drop. From the top would be 38%. This is 37%. So we can probably expect another 30% drop as well. If you want to put this, another 30% will put us around 54,000, 55,000 ish. So and this usually takes about the sudden drop takes 3 to 4 weeks, right? And then the accumulation leading to the next one is about 9 weeks. So this one is, so probably very soon in April. In April, Bitcoin's probably gonna drop again, and then if you see the previous few bear markets, one sudden drop was not as bad, but one sudden drop goes back to the bear market resistance band, which is the 50 SMA, goes back again, goes up, and there's a pretty long accumulation phase at the bottom, and that's another drawdown as well. A pretty long accumulation, 200 something days. So if you look at this, 200 something days, I think we are pretty close. We'll get pretty close in September, October-ish. So definitely think crypto has more to drop. But right now, I wouldn't really try to short it yet. Usually, we'll try to catch up to the 20 EMA and drop again. So maybe we can go up to 80K, high 70K, and then have another vicious drop down. So not too eager to short right now, because I think Clarity Act is still trying to get passed. Because if you circle, I had a pretty good past few weeks, all off of the news, and also earnings, of course. Draw the previous resistance zone, they got rejected pretty perfectly there. Well, but we don't know if it's gonna keep going up, right, or chop a little bit and go down. So not too rushed to get into a short just yet. And if you look at coin, also doing pretty well since the low. Recovered definitely a lot more than Bitcoin itself. Okay, so coin looks a little bit more bearish than Circle. Well, Circle is stablecoins, and I think the act itself is about stablecoins. So definitely all the stablecoins companies are doing a little bit better relative to the rest of the crypto industry. Okay, now let's move on to another very important chart, which is the dollar. So, the dollar basically controls the liquidity of the entire market. As it's going down, and you can kind of see this is basically like an inverse of risk assets. We can also put Bitcoin in there. So as dollar is going down, in this phase we're accumulating somewhat, risk assets will go up, right? And as we see a bottom in dollar, As it's rallying, this kind of calm down a little bit. As it's rallying, calm down a little bit. Of course, there are times that, it kind of correlates to each other, but this is more so just a conflict between like cyclical, and also I think this part was when everyone's buying gold or something, right? Yeah, so you can see it. Money is going somewhere, right? If it's not going to S&P, if it's not going to Bitcoin, it's probably going somewhere else. Also put US oil in there, and it's getting a little bit messy. Let's just hide oil for now. So as you can see, this big drawdown. Of course, liquidity is somewhere, and it's going to gold, right? At this point. And that brings us to the gold chart. Let's look at gold a little bit closely. Also, another very important asset. So what's weird is that when there's conflict, when there's uncertainties, people used to fly or flee to gold, right? And this is why gold has been having a pretty good run as of late. But ever since the war happened, of course, there's a lot of margin issues with the commodities exchange and all that kind of stuff, triggering a lot of liquidations, margin calls. This is what caused this big drop in gold. It hasn't really been doing too well, actually, and it's sort of deviated from my thesis, because I thought if there is a Middle East conflict and if there is a war coming, gold would rip again, right? But instead, it's sort of just been chopping in this range. So it seems like the market hasn't made up its decision on how gold will react in this situation, mainly because most people are playing oil now, right? As you can see, ever since liquidity went away from gold, it started to accumulate oil. I think this might be some, people taking profit in gold, rotating to somewhere, accumulation phase in oil, and then as gold is sort of just kept catching up back up to the highs, oil exploded. Right, so all the money started flowing to oil. This had a drawdown, and it started just drifting down a little bit. Hopefully, the 50 SMA can help support gold a little bit, but right now it is a oils market. Everything depends on oil. So I don't know what really happened here. Probably a lot of profit taking, a lot of shorts piling in. I mean, there's a lot of interest within oil. Governments usually want it to be low so that there's no inflation risk. Because I think I don't really know the exact number, but it does really screw up the inflation if oil price is high. So especially the U.S. government has a very big interest on keeping the oil price low. So they probably have some intervention, have some sort of, Trump saying things to make sure oil doesn't fly all the way up to 150. So it's also very extended right now. So we'll see where this goes. I think it eventually will go to 120 if the Strait of Hormuz and the Iran-Israel-U.S. war doesn't really get resolved anytime soon. And a lot of big economies really rely on oil. I think Japan imports 70% of its oil. I mean, Japan sort of been trolling. If you look at UK, right? It also took a pretty big hit because I think people are pricing in that it's hard for Japan economy to function well if oil price is high. So actually, a lot of markets around the world do very much care about oil prices. Okay, now let's look at another very important chart, which is the U.S. government bonds 10-year yield. This is sort of on the longer end. And it also does pretty well. So yeah, whenever yields go up, that means also there's a lot of money parked in treasuries. So if yields go up, right, that means it's a little bit more of an attractive asset. Like you get more interest as you buy this basically risk-free asset. Well, the argument of risk-free has been sort of an issue for the past few years, as U.S. debt reaching its all-time high. People starting to trust government less. That's also a factor where yields is going up. I think if you look at U.S. 20, it might even be worse. Well, okay. Well, yeah, so it's 4.819. 1.204. Okay, yeah. So this also is a pretty good indicator of where interest rate want to go. So I actually don't know how to pull up the 2-year chart, because I think that's maybe 3 year. I don't know, 5 year. Yeah, I don't see these, but it's essentially U.S. bond yield is forward looking compared to the Fed rates. So the Fed would, based on this decision, a lot on, of course, economy, inflation data, all sorts of data, actually job market data, and of course also the U.S. Treasury data. So if people are demanding higher yield, then usually Fed will also raise rates, and liquidity will be pretty tight. So as you can see, as the yield was going up, S&P was sort of trending down. It's almost like a perfect inverse at this point. Of course, the correlation breaks certain times. As you can see right here, yield took a big dump. So did the market. I don't know how to really explain that, but this is also another chart we need to look at pretty closely. And another thing is Japan yield. This matters a lot because it sort of kills the carry trade. If Japan bond yield is very high. So I think before it was like near zero, right? For very much, even negative at points. So these were when anyone could just do the carry trade, borrow yen for free, basically, and then convert them to U.S. and invest in the U.S. market. And put in, see, whenever yield is low, it's basically just markets going up. Right, and as it's hiking, of course, it went down a little bit, but as it's getting even negative, people are more aggressively borrowing the yen, trading into dollar, and then investing in the market. But I think people sort of have been ignoring this time bomb. And I drew a box here because I think this is where Japan's 10-year yield will go to at the end of the year. So if Japan's yield is going to get higher, I feel like this is going to be a pretty bad news for financial markets around the world. So I'm actually bearish for the next year or so. Okay, what are some other things we can look at? Oh, the VIX, probably. Anything else? Oh, yeah, emerging markets has been doing good, but not anymore. Yeah, it has had a pretty good run for the past few years. People are now starting about the U.S. market. They will put their money somewhere else, right? And of course, the EM, usually when there is a good run, it returns better than the S&P, but I think long term, it's S&P still wins. Okay, now what else can we look at? I think that's about it for the market today. Maybe some lower time frame stuff we can look at. Maybe S&P. Yeah, I mean, it's not looking good, right? Like, this is where I think the market will eventually go, to this major support zone. Yeah, I think that's about it, man. So, thank you.